Annie was in the lockup. Annie, you just heard Paul Bagnall talk about the door possibly being left open to a future rate hike in this country. I think a lot of people were hoping that this would be the last. Tell us more about what you're learning today.
Well, essentially what the Bank of Canada did today, Marcia, was signal to people that there's still potentially more pain to come. They're saying that the economy is too strong. They're saying that the labor market is still tight. They're talking about the fact that housing has now started to go back up again. And so essentially what they're trying to do is signal to people that the economy is too strong, consumers are spending too much money, and that's why they need to hike. You heard Paul talk a little bit there about potential signals that maybe the Bank of Canada will hike again. Their next rate hike or rate decision is going to be in September. The question is, will they hike then? Well, if you look at the monetary policy today, they talk about the need to get inflation back down to 2%. And there is no mention whatsoever about a pause in interest rate hikes, which is something that we had seen in previous monetary policy reports. So really the Bank of Canada is leaving the door open to more hikes. Again, that decision is in September. What they're going to do essentially is look at all of the market indexes. They're going to look at GDP. They're going to look at inflation. They're going to look at wages and growth and see how the impacts are going. Are these, major indicators of economic health declining? And if so, maybe they don't raise it in September and they wait. But really, the door is still open, as Paul was saying, to another hike. And, without the Bank of Canada specifically saying that they are pausing rates, it really does mean that anything can happen over the next few months.
And Annie, this is going to hurt Canadians who are already struggling with the cost of living.
It does. Essentially what today's rate hike means, although a lot of places have already priced in this additional hike, it does mean that the cost of borrowing gets more expensive. So if you want to take out a loan to, fix your house, that's going to cost more. If you have a HELOC, that's going to start costing more. If you have a variable rate mortgage, that's going to go up as well. If you're trying to take a loan out on a car or buying a new piece of furniture with payments, these are all things that are going to go up. And that's exactly what the Bank of Canada wants. They want this temporary pain so that consumers say, you know what, instead of buying that new car, I'm going to keep my car that, is used but still works. The bank is really trying to rein in consumer spending. And in their monetary policy report today, they said that consumer spending was much higher in the first quarter of 2023 than anticipated. So they're trying to increase hikes to try to get consumers to save money, to not put money into the economy in the hopes that the economy slows down. And the Bank of Canada does say that the economy is slowing, that there are signs, it's just a little bit slow. They're anticipating that this quarter it'll be around 1.5%. They say over the next year, real GDP growth will be around 1%, and then they expect that to start picking up again in 2025.